thank you very much for joining us for Microsavings, a fireside chat with Stuart Rutherford. So Stuart is the author of The Poor and Their Money and co-author of Portfolios of the Poor. He's the founder of SafeSave, which is a microfinance institution in Bangladesh. For more than 40 years, Stuart has been talking to poor people about how they manage their money in Bangladesh, Burundi, Cambodia, China, the Gambia, India, Kenya, Mexico, Nepal, Nicaragua, Pakistan, Philippines, Rwanda, Somalia, Sri Lanka, South Africa, Tanzania, Thailand, Uganda, and Vietnam. Incredible. So Stuart has recently written an article on microfinance and savings for a forthcoming issue of the Oxford Review of Economic Policy. And our discussion today will focus on his insights from that article. My name is Meki. I'm an associate professor at the University of Oxford, Department of International Development. And Simon Quinn, who joins me, is an associate professor at Imperial College London, Department of Economics and Social Policy. The two of us are co-editors of the forthcoming issue of the Oxford Review of Economics Policy. And today we are interviewing Stuart on the piece that he has written for that special issue. So thank you again, everyone. Thank you, Stuart. I'll begin with the first question. You've had an extraordinary career, Stuart, notable in particular for decades of discussions with so many poor people about how they manage their money. For you, what have been the key insights that have flowed from these conversations? And how do you see those insights as differing from, for example, from the insights that one of our students would get from a standard textbook in economics or finance?
Well, thank you very much, Mohammed, and let me say how happy I am to be having this fireside chat with you two distinguished gentlemen. Mohammed, that's your question. I've never studied economics. I was a student first of literature, and then of the history of art, and then of architecture. So my insights never came from economic theory. They came from the observations that I made and the conversations that I had with poor people about how they manage their money. I wanted to know what they did, why they did it, and how their behaviors compared across continents, countries, across cultures. So what did I learn? Well, people have only three sources for the money they spend. There's current reserves, meaning what's left in their pocket since they last received some income. There's savings, meaning money that somehow or other they set aside from past income. And there's loans, meaning money that they promise to set aside from future income. Poor people, very much because they're poor, tend to have low levels of current reserves. So they are more often forced to turn to savings or to loans than rich people are. So money management for poor people is mainly about how to manipulate or to combine those sources, particularly the two main sources of savings and loans, to form the sums of money of many different values, which they need for current, future, and for long-term use. Now, I'm aware that that might sound fairly bland and obvious, but it has surprising and sometimes wonderful consequences. For example, the ingenuity of some of the devices that have evolved over time and that are found in use almost everywhere among poor people. Often, the design of these devices allow uneducated or entirely innumerate and very poor people to use them with confidence. And I think later on in this chat, I'll have an opportunity to give you an example of what I mean by that.
Thank you.
Thanks, Stuart, and I'm going to look forward to that opportunity in due course. I wanted to go a little bit further, following exactly from this answer, to ask about financial diaries. You've been a pioneer in the use of financial diaries, and I'm curious to hear from you what we gain from financial diaries that we do not get from other kinds of data on household finances, And related, while I have you on the topic, do you think that the move to digital transactions with their very detailed resulting transaction histories will make the financial diaries style of methodology more broadly applicable in the near future?
Yes. David Hume of Manchester University and I devised this financial diaries methodology towards the end of the last century, mainly because we felt that the rapidly emerging microcredit industry of that period was built on assumptions rather than on observations and evidence, and was therefore in danger of falling into crisis, which it did indeed do several times over. So I ran the first primitive diaries in 1999 to 2000. Our idea for the diaries was that because finance is the interaction of time and money, we'd better track poor people's behavior with money regularly and in detail, frequently, over long time periods, if we want to avoid the misunderstandings that so often come with standard one-off household interviews. And I think that remains the principal contribution of the diaries methodology, although I must say that others who have taken up doing diaries have since enlarged the scope of what diaries are capable of quite considerably. Financial diary data can be and is already being collected digitally, and if it's done properly, it can help to improve the diary's data. So I'm quite optimistic about that. But on the closely related issue of digital data that's collected commercially, that's scraped from phones and the like, I think you will both agree that results are extremely mixed, not to say pessimistic, especially in the rapidly expanding industry of abusive smartphone applications built by loan sharks. And regulators really do need to get their act together to fight these monstrosities. But you know, there remain millions of mainly poor people who are not yet entangled in the web. Despite all the hype, I think you would be surprised to see how little digital finance impinges on the lives of the low-income diarists that we are tracking right now with our daily diaries in central Bangladesh, a country with a leadership role in digital finance.
Thank you, Stuart. Very interesting. And I would direct people to a couple of articles that we have in the special edition of the Oxford Review of Economic Policy, which focus specifically on digital finance, exploring some of these issues further, and also an article specifically on regulation of digital credit.
Yep.
So in your article for the Oxford Review of Economic Policy, you use this interesting term, usefully large lump sums. And it's a concept that you and your co-authors have also used in the 2009 book Portfolios of the Poor. Related to that, you have this fascinating discussion in the article about a woman who had put some money with a neighbor, and you note that you weren't quite sure whether she was saving or lending when she was doing that. So my question is, do you agree that as researchers and practitioners, we often overstate this distinction between micro savings and micro lending, and perhaps understate the importance of the motive of lump sum accumulation?
Yes, broadly, I do think along those lines, although no one should think that I believe in some mysterious way that loans and savings are the same thing. They are different things, but sometimes we do exaggerate by creating these two silos of savings over here and loans over here. We often miss the opportunity of bringing them together and miss the connections between them. So I should explain, I think, to people who are watching about that woman that you mentioned. It was in my early years of research. She said, recently, quotes, put two sums of money with a trusted neighbor. One was some cash that she wanted to hide from her husband, and the other was some money that the neighbor had requested for an urgent expense. So I said to her, oh, so in the one case, you were saving money with your neighbor, and in the other case, you were lending her money. But she simply didn't see it like that. She said she didn't need to know whether they were loans or savings. She knew how much she had put, and that was enough for her to keep her accounts. I reflected on that, and I saw that she was right. Now, since then, because this was early on in my research, since then I found this language of putting and of taking all around the world. And some of the best informal devices are built around this idea. Take the ROSCA, the Rotating Savings and Credit Association. Quite well known. A lot of your viewers will know what it is, but for those who don't, it's a club in which the members, let's say 10 of them, agree to meet regularly, let's say weekly, and each agrees to put in a fixed amount each time they meet, let's say $10. So at each meeting, one member would take the full $100, and the club would run for 10 weeks until everybody had put in $100 in small installments of $10 each and taken out $100 in one big, usefully large lump sum that they could do something useful with. ROSCAs, of which there are millions around the world, are a classic example of how low-income people can combine saving and borrowing in one hybrid system or device. So ROSCAs help people accumulate funds, and they do it with no need for pens and paper, no need for middlemen, no need to store money, and no costs. And outsiders do not make money out of indigenous ROSCAs. ROSCAs are really the world's most efficient intermediation device. And they have many startlingly clever variants adapted to suit particular situations. And I illustrate some of those in the OXREP paper that we're discussing today. ROSCAs should be better known and better understood. I am a great fan of financial education, but not for the clients. I'm a fan of financial education for the microfinance institutions themselves, who remain largely ignorant about the financial preferences of the poor and ignorant of how much better they could help them if only they took the trouble to learn. There is a world out there that has no need to know how to calculate compound interest.
Thank you very much, Stuart. This is a fascinating insight, and it leads us nicely to the next question. I've never quite thought of it like that. Financial education, not for the poor, but for microfinance institutions. I'll certainly remember that one. And I wanted to lead you on from there, because not only have you talked to so many poor households about their money, but you are, of course, also previously founder and chairman of a microfinance provider, SafeSave, in Bangladesh. And I wonder if I can invite you to tell our viewers a little about that experience, and also to reflect on the key practical lessons that you learned from this about what it means to provide financial services to the poor.
Yeah, sure. First of all, remember that I had been doing my own research into how poor people manage their money since the early 1970s, that is, before microcredit was invented. I started SafeSave in 1996 in some of the poorest slums of Dhaka, Bangladesh, because I simply didn't believe several of the founding myths of microcredit, and I needed a vehicle to test my beliefs. So what were the differences between what microcredit was doing and what we did in SafeSave? Microcredit herded its clients into groups and imposed on them a weekly obligation to repay loans. SafeSave, by contrast, treated people as individuals and gave them a daily opportunity, not obligation, opportunity to save, withdraw, borrow, or repay, or some or none of the above on each day when one of our collectors went to visit them. The loans had no fixed loan tenure and no fixed repayment schedule. Clients repaid as and when they could. There was no joint liability, which doesn't work. In SafeSave, savings could be made or withdrawn on immediate notice at any time. We tried, in other words, to provide the friendliest and most convenient money management service to poor people. Very soon, we found that the savings portfolio greatly exceeded the loan portfolio. We concluded from this that, given the option to exercise control in a trusted setting, many poor people prefer to build their own capital than to pay to borrow capital from others. Nevertheless, SafeSave was profitable from early on. Eventually, we handed SafeSave to BRAC, the big Bangladeshi MFI, in 2014. And I was in Bangladesh recently and saw that it is still running profitably. Indeed, BRAC is actually now expanding it a little.
Excellent. Thank you, Stuart. So I want to just come back a little bit to what you ended on for the question for the last one, which was on the theme of microfinance institutions and this memorable comment that you made about them perhaps needing some financial education. And so I wanted to ask, in your view, how important is this interaction between microfinance institutions and clients, in particular the loan officers, and what the role of the loan officers is? Sometimes feels that discussions in this space focus primarily on clients and their finances, which is entirely understandable. And to your point, perhaps we often talk too much about financial education for the clients. But is it possible that the collective focus needs to broaden to also include loan officers and institutions?
Yes, I think it should. And some people are doing it. I should say that I'm, contrary to some of the things that I may have seemed to have said in this chat, I'm not a Luddite. I do most of my own banking online, and I expect you to do as well. And I assume that in time, impersonal digital banking will prevail in most situations. But my interest has always been the money management of poorer people. And there are still close to 2 billion of them out there without access to smartphones and the like. And many of them are innumerate or illiterate or both. And for them, interacting with other people is the natural way to manage money. And banknotes and coins are the best way to represent money. They've been doing it that way since money was invented. And along the way, they've come up with some of the world's best money management devices, like the Roscas we were talking about earlier. Now, most of that human interaction that they are involved in is with family and friends and neighbors. But if outsiders like us want to help, if microfinance organizations want to help, our staff need to know how to engage with them. So I do take very seriously this question of improving the quality of the human interaction between microfinance organizations and their clients. I do not go to bed dreaming of machines that will carry out all of our transactions for us. Rather, I dream of machines that will help humans interact better with other humans, above all, with those in need.
Thank you very much. We've talked, I guess, started talking about clients, and then we talked about microfinance institutions. I wonder if I can ask one final question that maybe draws on some of the interesting chat we had before we started this recording today about the future of collateral, because obviously the original idea was very much that microfinance would not rely on collateral. We have seen that changing, and part of the change perhaps is often thinking about collateral often in housing stock as a valuable form of investment for the poor. It feels like this is an interesting issue that brings together the incentives of both sides of this discussion that we've had, the clients and the microfinance institutions. So can I draw you out just in a final question, Stuart, just to say something about what you see as the future role of collateral in providing microfinance?
Well, I think it's really tied up with the general trends in microfinance. I mean, what we've been seeing ever since microcredit got going in the 1980s, late 1970s, 1980s, we've been seeing it focus less and less on the poorest people and focus more generally on poor people, lower middle income people. And so micro credit started in Bangladesh in the 1970s and 80s with very much a focus on what in those days they called the poorest of the poor. That focus has largely been lost. And most microfinance institutions, as I understand it, I don't do as much traveling now as I used to, so I can't talk from personal experience as much as I used to be able. I do see that a lot of microfinance organizations these days are giving bigger and bigger loans to people with genuine businesses, and they therefore, their methods of work therefore approach more and more that of conventional banks. And so as part of that, more and more they take collateral. But one thing that I also see is that I don't see much evidence of a huge amount of success in realizing that collateral. So I see microfinance organizations that say they take collateral, but when I press them about, okay, how often do you demand that collateral, and how often are you successful in recovering your money through the use of that collateral? The answers are usually pretty soft. But one of the things that we were mentioning earlier on that you talked about, Simon, is this question of collateral in housing. And that made me think of my earliest days in Bangladesh when I was watching Grameen Bank experimenting with its housing program, which was very, very interesting. Partly because Dr. Yunus, the founder of Grameen Bank, who believed strongly that he wanted his poor clients to pull themselves out of poverty through developing businesses, realized that for many very, very, very small business people, their homes were their workplaces. And so he was quite happy to try to lend the money to improve those homes so that they will become safer and better places for them to run their small businesses. So he set up this loan program, which ran for many years, but was ultimately abandoned by Grameen Bank. I'm not exactly sure why, but I think it's because the rate of repayment for those loans were poorer than for their general loans. And that might be because Dr. Yunus insisted that microcredit was to be given without collateral. That was one of his great principles. Microcredit will be non-collateralized lending. Or it may simply have been that the loan tenures were too long and the clients just couldn't maintain the repayments for that period of time. But one very interesting thing that he did, that may have been forgotten by many people by now, is that one of the rules that he set up is that if you got a Grameen Bank housing loan, then the land upon which that house was to be built had to be transferred legally to the woman of the household. And interestingly enough, right now, amongst the 60 diaries that we're tracking every day in central Bangladesh, in Rishipara, we do have one diarist who is a direct beneficiary of that. A lady now in her 60s who got one of those loans with her husband maybe 30 years ago. Her husband subsequently left her, but she's still in that house, living in it as a result of this rather clever move that Yunus insisted on when he set up the rules.
That's a very nice, excuse me, a very nice story, and one that I think links back very nicely to that original aspect of that that finance. Stuart, thank you so much for joining us, and thank you to everybody who's been watching this. I know I speak for Mohammed and for myself when I say that for people who work in the academic space on microfinance, it is a real privilege to speak with you. In different ways, I guess we've all been learning from you for years, and to be able to sit and chat about your insights has been wonderful. So thank you so much for joining us, and let me thank Financial Inclusion Week for making this possible. Before I wrap up, let me give two plugs, as it were. One is on Stuart's virtual background behind him. The Rishipara Daily Diaries project is ongoing. It's very easy to find online if you Google it, and there's some very interesting insights on a rolling basis from that project. And finally, just to mention that this is all, in some sense, part of a forthcoming issue of the Oxford Review of Economic Policy focusing on microfinance. We're very fortunate to have Stuart and his article and a large number of other very interesting articles by leading thinkers in this space. And this is coming out early in the new calendar year. Stuart, thank you again. Mohammed, thank you very much. We'll all look forward to staying in touch. Thank you again.
Thank you very much, gentlemen.